All right, so stocks started the week on a down note, this to say the least. One of our bigger down days that we've had that we typically don't get this size of down day in a bullish market. It did produce a bullish signal on the market forecast. So I'm going to break that down, what that means, what it can mean for our bullish trend that we have right now going on. And I'm also going to break down just how, like some of the other asset classes, including what the dollar is telling us today, what bonds have been telling us the past few days. We're going to break all that down. Like we're seeing a narrative under the surface that's kind of telling us what to expect above the surface here pretty soon. So I'm going to break down my expectation for the rest of this week, where we go into next week with how we started off and some of the patterns that we're seeing on the charts here today, and a very typical sector rotation for the kind of move we got today as well, and that can be telling. So we're going to break that down. Our trade ideas in the stock that's showing us a very, very common and very significant candlestick reversal pattern. It's a stock. It's an area that we've had some trades in and some other trades in our classes. So we're going to break down a new trade in that particular area again today based off of that pattern. So let's go ahead and get started. Today is Monday, December the 5th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen, or the red subscribe button down below. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today down there. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. Hey, if you're watching on our blog, check out some of these things over here on the right, including our Market Outlook Live, some of the classes we have coming up. Come down here to the bottom, hit that heart. It opens up this tab. Hit that like button. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. The more you like and retweet and reply to those posts, that goes a long way for us in making sure our content actually gets seen by people who want to see our stuff. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. A few days coming off of this cluster, we've been down every day since, well, including the day of the cluster, we were down slightly. But the 2 days since have been lower. We went past the open of the employment number gap that we obviously filled in Friday. We went down through there and got back down to this 4,000 level, sitting right at it. Very important support level. So again, we've seen this before. This is a bullish intermediate confirmation signal. It's a oversold momentum line combined with an intermediate line that's in the reversal zone. Last time we had this right here, the near-term line was sitting at 50, and right now it's sitting at 47. We're a little bit lower on the momentum line than we were the time before that. But considering we're already here at the low point, there is a good opportunity for us that we can bounce right up off of this. Like if we're going to stay bullish, if this move has more legs to it, and we are indeed on the Tom Lee rally to the year-end new highs, or probably now new highs by the beginning of next year, if this is a correction and we got a correction bounce going on, which typically gets back to new highs within a few months, then we should hold right here, right? We should not break back down below 4,000, because that would now bring up the possibility of a fake out, right? We should hold at this 4,000 level. It's a strong support, Fibonacci support level. There's a bullish market forecast pattern here. We're still above the moving average. We still got dark green shading and green line. So we're still on board. But if we continue any of this weakness over the last 3 days, including that overbought cluster, into more than that, right? If the near-term line follows the momentum line all the way down the reversal zone, down to lower levels, and thank goodness we rallied at the end of the day, because if we had closed on the low, the momentum line was at extreme lows. And again, you don't get down to extreme lows. During a bullish trend, right? Not typically. So that would be a significant change in posture on a very short-term basis. So we don't have that. So far, so good, right? And remember, the Dow Jones has been more bullish. So it doesn't have as bad of a market forecast. We're not down as far, because remember, we're that 38 and 62. This is where the S&P is right on this level. So the Dow is actually still way up here. It did break back down below the 100%. So we had this kind of like fake out there, but we're not back down below that line, this yellow line, which would be the 62% of the year-to-date move. Boy, if we can't hold the 50% line on this year-to-date, you know, because again, remember, when we break back above these 50% year-to-date decline, market sentiment declines, we never go back down to new lows. We've already did it once. If we do it a second time, you know, then we're in bear market mode at that point. So we'll see if we're still above that 62%. So we should hold here. We should hold this support and bounce back up off of this bullish intermediate confirmation signal and keep going. NASDAQ, of course, has been more bearish. Remember, again, the 62 and 38. So these two lines right here, the S&P is right up here. The Dow is way up here, right? The Dow is at this level. The S&P is right about in this area where my cursor is. And that NASDAQ's way down here. So the NASDAQ is trying to get above the 23% retracement level. And it did on that breakout. And it's obviously back down below it and a lot more bearish. And still the same intermediate confirmation signal, still 2.5% above. And again, getting below these levels, again, there's a support here at the 38%. We should hold. We should hold here. And if we break back down, then it's more bearish. So we're kind of at this point where you expect the support to hold and this bullish intermediate confirmation signal to bounce, right? That if we are indeed bullish, if this trend is going to hold, if we are going to go up to, you know, at least up to, I mean, where the Dow is, back up to these August highs, like the S&P is relative. I mean, the Dow got above those August highs. The S&P got relatively close to those August highs. The poor old NASDAQ, which again has got a big chunk of the weighting of the S&P inside of it, is nowhere near its August highs. Nowhere even near it. Right? It's, you know, it can barely get above the 38% retracement. Of course, the Dow is above the 100% line, and the S&P is above the 62% line. If you look at the Russell, which is you know, kind of materials, financials, industrial, more linked to those, you can see it had the biggest breakdown, down nearly 3% today. This is a significant move. It failed hard at that 38% of the long term of the COVID rally, post-COVID rally, as well as the 62% retracement of this decline. So again, that's a hard breakdown. You're already almost at the moving average. So it actually had the biggest decline today. When you look at its daily price moves here, SPY was a pretty decent move. The last time we had this big of a move was the day before the CPI release. The CPI release came out and we really spiked up to the upside. But you usually don't get this bearish of a move during bullish trends. If you look at IWM, see, this is the biggest drop in IWM since this bullish move. Like we started the bullish move kind of over here on October. It's really October the 13th. That's where this started. So this is one of, you know, we've had a couple bearish moves here. Again, one of them being the day of the CPI release. There's not really anything going on here. We had, you know, the beginning of November coming off of the end of the month. We, you know, had a 3% decline, but we kind of batted around there. Again, this is kind of going into that CPI, and we changed. We're not going into anything like that's you typically don't get that big of it. I mean, look at this bullish run between mid-June and mid-August. We never got close to a 3% decline there. So this is not a typical type of a drop during a bullish move to the upside. So that's something to kind of keep an eye on. If you look at the long-term chart, the weekly chart that we like to look at from a Hakinyashi basis, we did get it's only one day. We do have a lower close, so it's not a bearish candle, but it is got the makings of a transition candle. We'll watch to see where it ends up by the end of the day. You can see the MACD is falling. This is the size of the candle, is falling pretty sharply. And then your PPO is still rising. You still got the green arrow. So we're trying to get above that. Remember, the Dow is way up above it, right? They're way, way, way up above it. But the NASDAQ is nowhere near getting above it, right? It's barely above the 10-week, and it actually does have a higher close. The last week was, you know, had an upper and a lower shadow. So kind of an interesting. It's not really a bullish pattern. In fact, looking at the whole moving average for the S&P, look how close we are to flipping that. We already have a bearish candle. We're not red on the moving average yet, but we have a bearish candle there. You can see IWM was even more bearish of a candle here, and we're below it. And you can see we haven't flipped that up yet. You see where the diamonds are. You see how close to those parabolic SARs we are on all of these. So that's how close we are to flipping things around if we have any kind of weakness towards to lower lows tomorrow at all. So it's something to keep an eye on there. Looking at the 3 green arrows for everything, we have a red arrow. We have a red arrow in the S&P now. We didn't have that before. The Dow has never gotten 3 green arrows. The Qs still have 3 green arrows, and the IWM's got 2. Right, so it's fascinating seeing the discrepancy. The IWM finally got 3 greens on Friday, even with that the lower open filling that in. But just like that, you're to 2. So we're not 3 red arrows yet. We don't have pink shading here, but we're also not really strongly green either. You see the trend strength as well for SPY. It's still holding up, but you notice it's not getting the mature levels like the diamonds. The diamonds is like full on, let's go. Right, whereas the Qs can't get a trend going at all. There's been no trend. It's still in the cloud. You see, like it's going to be hard for the markets to be strongly bullish if the Qs can't get going, at least to the degree that the broader market is, or even IWM. Right, IWM at least has an intermediate trend strength and is somewhat above the cloud as well. But you can see, remember, being above the cloud by the time it turns green is very important because green is the bullish crossover plotted 26 days forward. So we need to hold that bullish crossover by the time we get to that 26 days. And so it's real, but you see how close we are. Like the diamonds aren't close, but IWM and the Qs are very close, right? They are very close to crossing, not being above the green by the time we got there. So very, very important because that means, again, if we're not above the green, then we are starting the bear market, right? This will be starting the move to and through the 200-week moving average, which, again, looking at the daily chart first, you can see so far right now, we're still above the point of control, but we're failing at the 200-day moving average so far. We'll see if that holds or not. The Qs are not even close to the 200-day moving average. IWM is also sitting right there, failing, and all the moving average, except for the 50, are kind of sitting right there on top of each other as well. Getting back below this level will be really bearish for the IW, and you can see we've been converging. So it's not like we're set for it's not like we're forming a low point right now. We are actually forming a high point. We're basing it to the upside. We already peaked on the MACD histogram. We already peaked on the MACD. We've been converging ever since. The MACD, you see, has been coming down, trending lower pretty much this entire time as we've been kind of floating to the upside. So that's the problem too, is like we're not really like basing here or consolidating for a new move to the upside. We're actually consolidating the rally, forming a base on the top, forming a top essentially. When you look at the weekly version of this, again, this is the idea, like getting down here. Let me go to 5-year. Getting down to that 200 week, like we need to hold this breakout above the 30 and this gap, and you can see we're like we did over here when we got into that gap. We're failing so far. It's only 1 day, so it's not the end of the world. But as of right now, you can see IWM is still inside that gap between the 30 and the 50 and not getting through it. The Qs can't even get above the 30, right? It's actually failing at the 30-week moving average. You can see the histograms for the MACDs are rolling over on all of these. The diamonds, we already rolled over before because we had the long lower shadow last week in the diamonds. So this is the second week of rolling over, and it's a very high peak on the momentum. And you got a volume node up here at the top. You got some resistance up here. The MACD, we are above the 50-week. The 8 and 17 got above the 50-week. Again, if this were the S&P, we'd feel great about life. But this is not the S&P. This is a hand-selected group of companies that's price-weighted average. So that it's not like the highest market cap stocks have the biggest weightings. It's just the highest price stocks have the biggest weightings. So it's going to give you issues like this where it kind of does its own thing. And it's not necessarily, it's not a market leader when it does its own thing because it's not market cap weighted. So usually when it diverges, that divergence ultimately works itself back out. And as we saw in, early part of 2021, when these kind of stocks really took off here and kind of peaked, like we kept going, but the relative strength has really started to take a dive from that March peak. Whereas the Qs kept going up high, much higher, started to outperform, and these kind of stocks really started to underperform. And considering here you've been a lot more bullish, and we're still below moving averages in other places, The correction would, I don't think the correction would just be underperformance. I think it would be underperformance as everything comes back and makes a new leg lower. So, I've been painting this picture that we are set to bounce tomorrow if we are due the Tom Lee rally. I don't expect we are, and I expect that we'll actually break these supports this week. And I don't think we're tanking this week, and I don't think it's going to fall off the table. But I do think it's going to break that it's going to work through that 4,000 level. It might go up and down a few days, but it's going to work its way. It's going to chisel away at that 4,000 level, and maybe by the end of this week or next week, get below and stay below it. After some ups and downs through it over the next so many days. So that's kind of how it's a really important level. You saw across a lot of the major indexes. Looking at the intraday range here, let's pull up this chart here. Looking at the intraday range, obviously we've got a lower high and a lower low, so we did not get a new high today. We didn't get a new low either. The new low is going to come up tomorrow to there, and then by the end of the week, the new low is going to be way up here. So this gap, like once we break that gap, then it really has got, it's just downhill from there at that point. It's just pretty much downhill from there. So really, really important. But you notice here that the Arun indicator, remember I told you that this has got to get to 0, and it will tomorrow. And already did anyway. The green line's got to get below 70, and then that sets you up for the new breakdown. So by the end of the week, as we're chiseling away at 4,000 in the S&P, I expect that this green line will continue lower and get below 70, probably by the end of next week or Monday, or the end of this week or Monday of next week. And then this will be hanging around here, around 0. And then we will be set up, we will be susceptible to this move, which will be the breakdown and the start of the new leg lower to the downside. When we get the new 4-week low point, we will be really susceptible to that. When the low comes here, and after this one, so after a week, probably by Monday of next week, it will actually be right there. So, the current midpoint of the 4-week range will be the low point of the 4-week range if we don't break into that gap between now and then. I don't think we will. I think we chisel away. We go up and down. We come up in here. We come down here a little bit more, and we build up a really big node. And then I think the week after, if we're going to go down, and that's the way I'm leaning, I think it will be more next week. We'll really break down below this level, get a new 4-week low point, get that spike on the Arun. You see the other thing that's really setting us up for that move is the McClellan oscillator, right? It got down to 2. It almost went negative. That's a significantly low level. That's hard. We did bounce up. There was another instance right over here. We did get down to minus 0.5 there, and we maintained a bullishness. But we were, again, on a bullish move at the time. This was 2021. We're not in a bullish trend now. We haven't had one since. When it's gotten down to really low levels, like here, it broke down. When it got down below levels here, which is slightly negative, it broke down. When it got down to these low levels here, it broke down. Now here we are again to the lowest level of this bullish run. I expect that we'll break down over the next few days, over the course of the next 5 to 6 trading sessions. Let's take a look at volatility. So here's our volatility index. And you see the VIX was up today. Wasn't necessarily, sorry, I want to look at this one here. The VIX was up today. It's back up above 20. And it's back above 85%. Getting above 90 will be the bearish move. So I think we still stay within the next week between 85 and 90. You can see the VIX rate, the correlation with the VVIX over here is still really low. It's typically very bullish when the VVIX is really low. So here, let's go back to a daily chart here. When the VIX is really low, as it has been, and the VVIX is also really low but starting to move up, that typically leads, when this correlation is negative, like it was over here, it typically leads to a bullish move. And this is kind of we had a little bit of a double dip down here. It didn't quite get negative there and led to that bullish move. I'm expecting that we'll get a bullish move with this negative correlation, slightly negative correlation with the VVIX extremely low. This is where it was in mid-August, right? So that wasn't as low as it was here. So I expect that we'll make a run up above 100, up into 115. I think we have the conditions set up for a new leg lower to the downside that ultimately It won't happen this week, but ultimately, as we go over the course of weeks, we'll make our way to and through the 200-week moving average, which is that third stage before the bear market starts. It is basically the trigger that starts the bear market, right? You have the pullback, the failed pullback bounce, the correction, the fail, which happened to be a couple here because the IWM actually did hit the 200-week moving average there. You have the correction, you have a failed correction bounce, so it's kind of a double-headed monster there. And then now the third stage would be the move to and through the 200-week moving average down towards some support levels, and then the return move back up. So in this case, it would be down to like 3,200, down into this 3,200 area. I expect the move back up towards 3,500, and then the bearishness begins. At that point, then things get really like if you thought this was a bear market. After we get the move to and through and a return move, if we do, the move from 3,500 down to wherever we ultimately get down, like if you think this is a bear market, then I mean that's going to be like Splash Mountain, right? This is going to be like a nice little soft little rickety white wooden roller coaster, and then once we get to down and back up. And we roll back down, that's going to be Splash Mountain at that point. And it might take that took between 2000 and it took over a year. It took 18 months in 2000, the bear market 2000, 2002, that move from the 200-week, from the return move peak down to the washout to the low point, the ultimate low point, was 18 months. It was about 9 months in the 2007, 2008 peak. From the return move peak, after you got the move to and through, and then the return move back up, from that peak down to the ultimate low point was about 9 months. It was about a year in 73, 74. So that's where again I expect will be below the 200-week moving average for most of 2023, following the same kind of trend as we see here. So again, we break up above here. This support holds. We get this bullish intermediate confirmation signal. We bounce back up to new highs by the end of the week. We just continue to push through and up and beyond that 50-week moving average. Great. Tom Lee rally, here we go. Which it was interesting. They finally talked about. They actually called it the Tom Lee rally in CNBC. It's like, I think one of the producers on that show is watching my Market Outlook videos because we've been calling it the Tom Lee rally every time he's talked about it. Even back here, we were calling it the Tom Lee rally, getting back up to new highs. By the end of the year, because every day the market rallies, they bring Tom Lee on and they ask him what he thinks, and if this is it, and he always says yes. So here we go, back up to new highs by the end of the year. So he wasn't on today, I don't think. I don't know if they actually brought him on today because it wasn't an up day, so maybe not. But that's what we have going on here, and let's take a look now at the asset class movers here today. So let's change the time frame on this down to December the 5th, and we'll just go look at the last few minutes. And you notice again the dollar was the big mover to the upside today, which it's been so bearish, but the dollar was up, yields were up surprisingly because the Fed's still raising rates. Isn't that interesting that the yields were up today? So yields were up, the dollar was up, but this time commodities was not higher. Commodities actually crashed. They had more of a bearish move than equities did. Remember, commodities are in this catch-22 situation where you either rally up to the upside, and inflation becomes an issue, or you break down into this gap, which the only time we ever break in and fill in a gap this big is in a demand destruction recessionary period. I mean, that's this breaking down, and commodities breaking down to fill in that gap will not be bullish for the markets. I mean, it would cause deflation, which obviously would bring inflationary levels down, but it would be a deflationary event, considering how big the gap is between the 50 and 200-week moving average. So today's move, is not necessarily what you want to see if you're trying to avoid that scenario. It's either one or the other. That's the catch-22. And when you look at the dollar as a safe haven, when U.S. equity, look at that, holding the 200-day moving average, holding the 38% retracement of this longer-term move that it's on right now, coming off of this mid-2021. So this longer-term rally, from the low point below the 200-day moving average through it and beyond, We're sitting on that. We're at the 50% retracement of this current rally we've had since the beginning of the year. So there's some support here, and there's a volume note as well. There's just some support here in this area, and it was a big mover. Now it's still below the 8-day moving average, but you notice, look at the divergence we have going on. So we've already got the low point on the MACD histogram and the MACD. We've got higher lows developing across both of these with much lower lows here. If we take a look at some of the other oscillators here, like the RSI and the CCI on the UUP, you can see the RSI is giving you slightly higher lows. The CCI is kind of giving you equal lows as we've gone progressively lower to these levels. If you look at the DMI for the dollar, you'll see that the DMI is getting us lower highs on this. So, with these lower lows, that's a divergence pattern. Obviously, a higher low as well on the positive indicator with lower lows. Also a divergence pattern with the ADX really, really high for this bearish move. So like it is setting up. The dollar is setting up for a rebound. In this case, it would be a kind of a safe haven rebound. As in fact, if you take a look at today, the currency movers today. Here, let's go find the currencies. They are right here. We'll do the comparison. So when you look at the currency movers just today alone, so let's go to December 5th, and we'll go out to just a few minutes. So there's your dollar. Your euro is actually outperforming everything else too. Your yen was down. Your commodity currencies were down. Mexican peso, Norwegian krone, these are related to commodities too, to a degree. The Canadian dollar was down. The Swiss franc held up. That's a safe haven asset class. The British pound held up better than these commodity currencies. So, and the yen, I'm surprised the yen was actually as bearish as it was, because it's typically would hold up too, along with the dollar and the Swiss franc. But you can see how the Aussie yen and the New Zealand yen, which is a proxy for risk appetite, when you look at that currency pair, the Aussie versus the Japanese dollar. Again, this is a proxy for risk appetite, and look at what it's doing. Like, it's breaking the 200-day moving average. Like the yen's been so bearish, but typically, like when this goes up, the market's generally, risk appetite goes up too. And then when the yen goes up against the Aussie, that's usually a safe haven. So the fact that we've been bullish, the risk appetite's been minimal this year while this is still rallying, shows how bearish the yen is. But now the bearish is rising. And again, that's not necessarily bullish for risk appetite. When the Aussie falls against the yen, that's more bearish. And if you look at just how bullish we've been, we are now, we filled in the gap down to the 50. We break this, same thing with the commodities. If we fill in this gap, that won't be a bullish thing. It would actually be a bearish thing. You can see during COVID how far it dropped. And you can see the reflection of the bear market that we didn't really feel the effects of here in the U.S., from 18 to the COVID low, just how bearish it was during that entire period, how strong the yen was. So another sign of a demand destruction, in this case for commodity-related currencies, if we fill in that gap in between those two. Let's take a look. We didn't look at the TLT, the bonds. We talked about TNX rising. Remember, the Fed has got 100% priced in at 4.5% by December, by a little more than a week from now. Next week, 100% odds of us being at 4.5%. We're just now at 3.6. So that kind of gives you an idea of where how far the 10 years. I mean, we're at 4% right now. That's how far the 10 year is inverted with the overnight rate. And it's going to be even more unless the 10 year rises to catch up. And look how bearish the markets were with this one move to the upside today. I mean, there is some opportunity for the 10-year yield to rise considerably, and I don't know necessarily. And you can see we're hitting that 23% retracement level here. I don't know if the markets can handle the TLT dropping back to these lows, or TLT or TNX rising back above 4%. Right? If TNX was back above 4%, we're going to be back below the 200-week moving average considerably. Right? We're going to easily be on the move to and through the 200-week moving average. So very important to keep an eye on. One-day phenomenon, great. We bounce off of this tomorrow. We keep going up throughout the end of the week. Tom Lee, here we go. Everybody send him a Christmas card. Wish him a Happy New Year, because 2023 is going to be great. My expectation is it's not going to be so great. And you're not going to see Tom Lee very much on TV throughout most of the next few months, because we're probably going to end up, again, chiseling away at 4,000, going down and up throughout most of this week, before probably next week when we get more of a sustained decline, more of that gradual move lower to the downside. One more thing, I want to look at the sectors. So let's take a look at the sector moves here. Again, just so you can see that, look at the big crash, then these sectors, these cyclical sectors have been doing so well. But you can also see pretty much everything declined today. And if I look at, again, just today alone, December the 5th, and come back up here to 2 minutes, you can see, safe havens were the only things working. Everything was down. Energy has got its butt kicked today. Consumer discretionary, financials got its butt kicked today. Materials is down. Technology is matching the market down there, as you expected would. Biggest sector weighting by far. And safe havens outperforming. There's a risk off day. I expect that we'll probably get some more of that. I think we're going to start to correct some of this and work our way back down to the downside. It's a nice little run. Here's our year to date so far for the year. It was a nice little rally in these cyclical areas. I almost get back to break even for the year to date, but I think we're probably going to start. I think they're going to end up working their way down towards these areas, these other sectors, these 25 to 30% return, 35% returns. And I think energy's got to, again, if commodities break down, XLE is so diverse to the upside. There is no margin of safety whatsoever in those areas. That's going to be one of the hardest hit areas. And a lot of those stocks got hammered today. Speaking of that, so our trade idea is actually on Halliburton. We have a trade in our class portfolio on Schlumberger, and we actually have a trade in Halliburton as well for December expiration. But let's take a look at January expiration, and you can see after kind of a double top here, at this peak, we got a significant engulfing pattern. We got a bull tag, light pink shading, yellow line. That typically would be pretty bullish, and you don't quite have the intermediate confirmation signal, because you notice the intermediate line never did get back above market sentiment. Still actually below market sentiment there. So pretty significant decline here on Halliburton today. That's a significant engulfing pattern, engulfing really 3 days worth of candles, and then closing today after gapping up, closing all the way back down all three of these moving averages. Still not quite, back down below the top of the value area. You tried to break out, not quite below the node, but you can see kind of how far it would have to go. Here's this is the rally up to the upside. Let's remove this one. I want to take a look just at this move that we've had. Let's go here. Let's go from the move from here, from that Harami pattern, all the way up to the peak that we're on. We'll get rid of that. That's a break even from the other trades. You can see we're still between 0 and 23% retracement up there. So we're not breaking down. The MACD's been converging this entire time. That's how close it is to getting going negative. It's also close to a green arrow. The stochastics is in bullish territory, but doesn't look like it's going to work its way into bearish levels. If you look at the trend strength for Halliburton, we lost the bullish trend, so there's no trend at all. You're easily above the cloud, but you can see where the cloud is. Just a few weeks from now, you can see kind of what we're up against here. If you look at the RSI and the CCI, they failed to sustain bullish levels here. They didn't get above positive 100. They didn't stay above 60. They're already working their way back down. The DMI, you notice, the negative indicator is still staying above 25. The positive is trying to break down. The ADX is gone, so there's no bullish trend anymore. And then finally looking at the Bollinger Bands for Halliburton here, you can see that, here, let's pop this open. We actually opened outside the bands, then worked our way into the lower half of the chart, so just barely into the lower half of the chart. And you can see we're inside, there's no momentum. We have the bands inside the Kelvin, so we're set for a breakout move. One way or the other, we're set for a breakout move. One way, and this engulfing suggests, that we might be more likely that we're going to break below these two lines down here and break the 38% retracement than we are to break above 0 to the upside. So as a result, I didn't want to be too aggressively bearish, so it's not like we're already breaking down, but I wanted to look at a bearish trade. So what I decided, instead of buying at the money, which is a little bit more conservative, but I didn't go like out to the low 20 deltas for the put. So instead I kind of went in between and bought the put at the 35 delta and then sold 2 strikes away. So I ended up putting a here we go. And let's get rid of the other trade. So this would be the bear call that we had on for December expiration. So I ended up doing about half my normal position size and getting a little bit more than the 2-to-1. So again, we have to get below 33 to get that maximum gain. And if you take a look at where 33 is, we basically have to get below the lower bands, including the lower Keltner channel and the 38% retracement. And I think we are actually set up for that type of move with this engulfing that we're getting here today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, remember to subscribe to our website, which you can do for free. I showed you earlier. Like us on Twitter and Facebook. That goes a long way for us. So we appreciate those that do that. Have a great rest of your Monday night, everybody, and we'll see you all next time.